The Money Show.
Personal Finance with Warren Ingram.
Personal Finance brought to you by Liberty, your financial partner on however and whenever you picture your retirement. You can live it your way. Hashtag in it with you. Liberty Group is an authorised FSP. T's and C's apply. Warren Ingram, personal financial advisor, executive director at Galileo Capital. Let's talk about dividends because, South Africa is sitting on a dividend yield. In other words, if you put 100 Rand into the stock market, you should get 3 Rand a year in dividends because we got a dividend yield of about 3%. And you go, well, that's not really money. I can put money into a fixed deposit and get 4%. So why would I care about dividends? Explain.
It's such a timeless question, considering the interview you did a bit earlier with the CEO of Afrimat, and I was looking at a tweet from David Shapiro today where he says Afrimat's annual compound growth rate, including dividends, has gone up by 32% a year for the last 10 years. So compare that to something like Naspers has gone up 28% a year, or Capitec at 25% a year. Interesting thing about Naspers, they don't pay dividends. And then for all the gold fans out there, which, as we know, gold doesn't pay a dividend, that's done 9% a year. So when you find a company that has a good ability to generate dividends, it has a huge impact on the ability for you as an investor to get some decent growth on your money by just staying invested. And as you earn those dividends, pay them back and buy those, buy more of the same shares over and over and again. I want to caution people not to now believe that Afrimat's going to give us another 32% a year for the next decade. I'm not saying that. It's just, here's a company that has a good ability to generate good dividends, and patient investors have seen their money double, every 2.25 years by just sticking it out, And I think that, that's really the power of dividends in a situation like this, is we get so focused on the stock market going up or down, and we panic and we sell when the market's gone down, and then we get, overly excited because the market's gone up. So we start to buy again. And all of that trading means that we're not earning dividends. And so when you're out of the market and using your example, if you just look at the JSE, you're probably going to get around 600,000 Rand from your 100,000 Rand investment if you stay invested for a longish period of time, and I'm thinking 20 years, if you don't reinvest the dividends. But invest the dividends and you're getting somewhere around 1 million Rand. So that difference is enormous. And all you've done is earn the dividend, reinvest it, and just stay the course. It's an absolutely powerful part of investing in shares. And I think it's something that we miss a lot as investors, because we talk about, the timing the market and, buying and selling at the wrong times. But the point here is dividends is the secret silent assassin in this whole thing.
It goes. There are a couple of really important points here. If you go and pay 100 Rand for a share that falls to 50 Rand, your dividend yield is going to be lower than somebody who paid 50 Rand of a share that went to 100 Rand, and their dividends grow over time. The cheaper you can buy a share, and this is again why the price you pay is so important, because not only do you want the capital appreciation of the share from 50 to 100, but you also want to be buying a share with a dividend yield of 4% at 50 Rand and watching the share price appreciate and watching that dividend grow every year. Suddenly, at 50 Rand, 5 or 10 years' time, that company might be paying a dividend of 10 or 20 Rand a year. And suddenly your dividend yield on what you paid is sitting at 20 or 40% based on the fact that you paid a low price for a share that continues to grow its dividend payments over time. And that's really powerful.
Absolutely. And I think, that's the thing to understand about dividends, is that they're not static like interest rates. So if you've got 100,000 Rand, and your dividend is paying, at a yield of 4%. So you're earning, your 4,000 Rand. Understand that if that company is growing itself, so if it's not just the share price, but if the company itself is growing, increasing profits and, doing its job fairly well, that means that it might be only paying you a dividend yield of 3.8% next year, but it could be a much bigger number. Instead of being 4,000 Rand, it could be 6,000 or 7,000 Rand. And as you say, it doesn't take long if you stay invested to suddenly see that income in rand terms actually just rocketing and maybe even paying for the price of the share that you bought. And I think that's the key here is, to look at this and to say to yourself, wow, that first 4,000 rand that I earned from the share was really nice. Let me go and, spend it on a bunch of coffees or whatever the deal. You're missing out on the ability to almost double your money over a longish period of time. And that's so powerful. And I also think, if we talk about the JSE, at a dividend yield of 3%, what's interesting about that is it's actually a fairly consistent number. If we go back probably, again, 20 years, it probably wasn't far off that same yield. But if we look at what the value was of the JSE 20 years ago, and I should have checked that before because Murphy will mess with me now, and it's probably exactly the same. I know it's not. But the point is, your money really is going to, grow in terms of value and percentage over that period of time. And you've done nothing, super smart other than buy an index, and just let it grow and then reinvest the dividends. It's not like you had to go and choose, the one share that's going to beat every other share in the market.
However, I mean, if you want to go back 20 years, I'll play the 20-year game with you. I remember a share that 20 years ago was at about 78 cents. That share today was at 1,668 rand. Okay, so you've had a good capital appreciation out of Capitec. Now, if you had bought that Capitec share at 78 cents and you'd held your and you'd kept your nerve during all of the various crises that we faced and through all of the negative reports that have been written about Capitec, not only have you seen capital appreciation from, let's keep it simple, from 1 rand to 1,600 rand, but you've also seen the dividend go from whatever it was 20 years ago as a fraction of the value of 78 cents a share. The last dividend that was paid, and that was in April this year, was 16 rand a share as a final dividend. So 16 rand after over for a share that you paid 78 cents or a rand for 20 years ago, and that's the power of growth and profitability within a business. And that's the real power of this thing: the growth in not only capital but also the growth in the value of dividends over time is massively, massively powerful.
And so, to people listening and saying, so what, we're talking about the last 20 years, that's never going to happen in the next 20 years. You're right. Whatever happened in the last 20 years, that movie won't repeat itself exactly. But it's amazing how many times the movie, plays a similar theme and delivers a similar story. And I think that's the thing to understand is we probably won't see Naspers, doing what it did over the last 20 years, but it'll be something else. It'll be another company. And, 20 years ago, convincing people that Capitec would become a banking powerhouse in South Africa, you probably would have been carted out in a wheelbarrow as a joke. And the thing here to understand is, there are going to be new companies that will come in and start to dominate their sector or their segment and deliver future growth. So don't be despondent that because we're talking about companies that have delivered fantastic returns in the last 2 decades or last decade even, that there won't be new ones. There will always be new companies with new entrepreneurs, finding new ways to deliver good growth and as you say, those reinvesting of those dividends. So I mean, to someone listening, I just want to say you've actually got to stay the course in all of this. We're going to get scared again. We're going to hear new bad news in the future, whether it's global or local. It doesn't really matter. There are going to be so many reasons to jump out of the stock market because we're afraid of something. And the point is, the people that haven't done that, the people that have just stuck it out through the good times and the bad, they're the ones earning the fantastic returns, both from dividends and capital growth. And that's the secret here is you've got to stay invested to earn the dividends and then benefit from these wonderful entrepreneurs delivering fantastic results.
There are times when even reliable dividend payers, however, don't pay dividends. I mean, Anglo-American got hate was the subject of vitriol and hatred probably 10 years ago when they'd spent too much on buying dodgy iron ore mines in Latin America and they were at risk of going bankrupt, and so they suspended dividends, and that was like the first time in 100 years that they'd done that. And people just had vitriol because there was such a heavy dependence on dividends. Last year, none of the banks paid a dividend because the Reserve Bank had said, please will you look after your capital and don't pay a dividend. You can pay another dividend next year, provided we all survive and live and don't all die of COVID and the economy doesn't fall in a complete heap, then you can reinstate later. But But for now, banks, please, for the stability of the banking sector, don't pay a dividend this year, and they didn't. So, I mean, this isn't absolutely guaranteed, but good businesses that are profitable and are sustainably profitable like to pay out dividends. They are cash back to investors, and as Warren says, you reinvest these dividends over time. It's like money babies, I've heard it described as, and you grow your family in this particular sense. It's really, really, really powerful. But also, Warren, word of caution, don't fall for the line. And I just remember so many people falling as African Bank was going down, the African Bank Investments Limited was going down the toilet, the former holding company of African Bank. The dividend yield went from 5% to 6% to 7% to 8%. People going, it's 10% dividend yield. This is an absolute sitting duck. We've got to buy African Bank shares. And then you lost your shirt. So be careful on the other side of that when it starts becoming just a little bit too good to be true.
Absolutely. And I think, there are two messages there. One, if you are going to buy individual shares, you have to do your homework. You have to understand the company that you're buying, and not just buy it on the performance of the share or just one metric like a dividend yield. You have to understand a lot more about the business than that. And secondly, you are going to make mistakes. The very best fund managers out there, they're really thrilled if they're right 55 to 60% of the time. So what that means is you can't just invest all of your money in one or two shares. You're going to need to buy at least sort of 10 to 12, so that if you get a bad year on a dividend or one of the shares that you own blows up, you're not going to be taken out and as you say, lose your shirt. It will be a loss, but hopefully more than made up for by the other shares that you own, or buy the index.
We're going to be in trouble with Kate, because Kate has asked us a question and she's demanding an answer. And I'd like that answer from you in a moment, Warren. I'll give you a moment to think about it. Recently, Warren briefly mentioned, there's a criticism, investment companies and how they are different to unit trusts. Can you please ask him to explain this more? Are they a good option for private investors? Kate, what a good question. That is the question to Warren. He will answer it, I hope, in a moment.
The Money Show. Personal Finance with Warren Ingram.
So, Warren Ingram, investment companies versus unit trusts. Kate would like an explanation, please, and whether or not these are a good option for people like her, private investors.
Thanks, Kate, for the question. And sorry it was brief last time. Let's try and help.
Well, hurry up! Come on, we don't have time here, Warren. Come on. Be brief.
So the thing about a unit trust is it is an investment where a bunch of different investors put all their money together, and that money as a collective or as a pool then gets used by fund managers to go and buy a range of different companies or bonds or properties, whatever it is that the unit trust is aiming to do. And when a new investor wants to go into a unit trust, what happens is the unit trust will issue more units to that investor. And so that means that it's what they call an open-ended company, because the amount of money in that unit trust will never stand still if there are investors who are putting money in, or for example, if they take out. Because if they take out, what will happen is they will actually sell units, and the unit trust itself will pay out money to the investor who has sold. So it means that with an open-ended investment like a unit trust, there is no control over what's going to be inside that fund on any one day. And so when markets are rising and if the fund itself is doing particularly well relative to everybody else, there might be lots of investors piling into that unit trust at that time. And similarly, if the markets are falling or the unit trust is doing badly compared to its peers, you might find people just selling out of that fund almost at any price. And that can have a lot of unintended consequences for the fund manager. So the difference is then, if you look at an investment company, it's also a business that's listed on a stock exchange. But what happens is it will list, and let's just say it lists on the 1st of June, next week. It might then raise 500 million rand from investors who will then own the shares in the company. But when they decide to sell their shares, it's not going to be the company that gives them the money back and then buys those shares back. What will happen is it'll need to be someone else on the stock exchange who decides to buy those shares from that investor. So it means that investment money that was in there at the start, that 500 million rand, might grow with the performance of the underlying investments, but it won't shrink or rise because of new money from outside investors on an ad hoc basis.
So is it a good option? is it a good option for a Kate? I mean, does one offer more protections than the other? In a minute, not that I'm rushing you or keeping you brief.
Okay, I'll be brief. So I do like them. I think that unfortunately there are not many high quality ones. In fact, no high quality ones in South Africa. So they are invested overseas. They are mainly on the London Stock Exchange and the US. And they are good for private investors, not good for big pension funds and big managers, because these were really designed for private investors. So yes, I think they are. Obviously, you have to do your homework. There are hundreds of them, not all high quality, but the good ones can deliver good returns for private investors.
And then a quick question for you. I'd like a word of the week, a phrase of the week. Outperformance. What is outperformance? It seems like easy one. What is it?
One of my pet peeves from fund managers. So they'll say, we've delivered outperformance because we've delivered growth that was more than the Johannesburg Stock Exchange. So we have outperformed the JSE. The fact that the JSE might have lost 50% and the fund manager only lost 40%, they're going to say we delivered outperformance of 10%. So horrible phrase, but that's what it means. It means you're beating a particular benchmark set usually by the fund manager for their own fund.
I'm getting into time trouble here, but the trouble is, often they say better than our benchmark or our benchmark, and often the benchmark isn't clear. You've got to really understand what the benchmark is, surely, before you can start accepting whether or not they really are outperforming.
Exactly, and a lot of these fund managers in South Africa will craft a benchmark themselves. So they'll say, "This is our peers. We've done better than our peers," and off we go. And I think they miss the point that a private investor doesn't say, well, how did you do relative to your peers? They'll say, how did I do relative to cash in the bank? Or, how did I do relative to the bond market, where I could have got a more sure return. So I think these benchmarks are kind of a fiction, frankly, a lot of the time for fund managers to make themselves look good.
Warren Ingram with Galileo Capital, uncompromising, not pulling any punches. Thank you, Warren Ingram, on a Thursday night. Retirement should be on your terms, whether you're looking forward to adventuring, entrepreneurship, or making time for relationships that matter. However you envision it, being able to retire your way takes planning and commitment, from saving, investing, and protecting yourself against risks. Liberty partners with you to get retirement ready. Speak to financial advisors today to achieve the financial independence to live your ideal retirement. #Retire My Way. #In It With You. Liberty Group is an insurer and an authorized FSP. T's and C's apply.